the Iran War and the collapse of a 40-year equilibrium. Almost no one is discussing a more fundamental question. The Iran War has destroyed far more than the life of a supreme leader or a navy. It has destroyed an interest equilibrium structure that lasted nearly 40 years, and the collapse of this structure will reshape the global energy landscape, financial markets, and geopolitical order. How the old order was established. To understand what is happening today, we need to go back to 1979. Before the Islamic Revolution, Iran was one of America's most important allies in the Middle East. Under the Shah's rule, Iran was a stabilizing force within OPEC, with oil continuously supplied to the West at reasonable prices. The United States, Saudi Arabia, and Iran formed the triangular foundation of Gulf security, with energy prices low and predictable. The revolution changed everything. After Khamenei came to power, Iran was ejected from this triangle and became America's primary adversary. The Iran-Iraq War followed, and global oil prices soared from $14 in 1978 to $35 in 1981. The world entered years of energy panic. But here's the key. Even during this 8-year war that killed 1 million people, a new equilibrium gradually formed. The core of this equilibrium was very simple. Although Iran was hostile to the United States, it chose not to close the Strait of Hormuz. This choice seemed unremarkable, but it sustained the entire Gulf economic order. One of Saddam's strategic objectives in attacking Iranian shipping was precisely to provoke Iran into closing the strait, thereby triggering U.S. military intervention. But Iran didn't take the bait. Even during the most intense period of the Tanker War, 1984 to 1988, when Iran and Iraq launched a total of 451 attacks on merchant vessels, shipping through the strait was never truly interrupted. Statistics show these attacks affected no more than 2% of total Gulf vessel traffic. Iran even proactively lowered oil prices to offset rising insurance premiums. Global real oil prices continued to decline throughout the 1980s, falling to less than $12 by 1986. Why did Iran maintain the strait's openness during wartime? Because its oil exports also had to pass through this waterway. Closing the strait would mean cutting off its own economic lifeline. More importantly, Iran's clerical class and revolutionary guards gradually became rentiers within this system. Oil revenues were distributed through a complex network of religious foundations, banyads, state-owned enterprises, and the IRGC economic empire. The IRGC's engineering arm, Khatam Al-Anbiya Construction Headquarters, had completed over 2,500 projects by 2017, controlling more than 800 registered companies. The operation of this interest network depended on the continuous inflow of oil revenues, and oil revenues depended on the strait's openness, the structure of the 40-year equilibrium. After the war ended, a more mature equilibrium structure took shape in the 1990s. The United States provided security guarantees. The Fifth Fleet was stationed in Bahrain, responsible for maintaining freedom of navigation through the Strait of Hormuz. The highest manifestation of this military presence was the 1991 Gulf War, when U.S. forces defended Saudi oil fields, while Saudi Arabia provided funding and fuel. Saudi Arabia provided capacity flexibility. As the swing producer within OPEC, Saudi Arabia increased production when global oil supply was shocked and reduced production when demand was weak, serving as the regulator of the global oil market. The insurance market provided the institutional foundation. London's protection and indemnity clubs, P&I clubs, provided insurance coverage for 90% of the world's ocean-going vessels. With insurance, shipowners dared to pass through the strait. With passage, oil could flow. With flow, oil prices could stabilize. Iran provided passive cooperation. Although Iran remained in continuous hostility with the United States, and although sanctions became increasingly severe, Iran never truly closed the strait. It used closing the strait as a verbal threat, but never actually played this card. Partly due to rational calculation, closing it would also harm itself. Partly because the clerical and IRGC rentier classes needed oil revenues to maintain their own interest networks. But this couldn't change the reality that the survival space of this interest network was being continuously compressed by the Gulf Order. The primary beneficiaries of this equilibrium were the Gulf monarchies. Saudi Arabia, the UAE, Kuwait, and Qatar exported oil and natural gas through Hormuz, accumulating trillions of dollars in sovereign wealth funds. Next was the United States. The dollar's role as the oil pricing currency gained crucial support for its global reserve currency status. Saudi Arabia used petrodollars to purchase U.S. Treasury bonds and weapons, forming the petrodollar recycling system. This system allowed the United States to finance its massive fiscal deficit at extremely low cost. Who was gradually excluded from this equilibrium? Iran. Sanctions limited its oil exports, compressing its crude oil revenues far below what its capacity deserved. The oil it could export was mainly sold at a discount to China, with layers of extraction by the IRGC and middlemen. Ordinary Iranians bore inflation, unemployment, and poverty. By the end of 2025, 22% to 50% of Iranians lived below the poverty line, and the rial-to-dollar exchange rate plummeted from 42,000 to 1.75 million. Israel was also not a beneficiary of this equilibrium. For Israel, a stable Gulf order meant that although Iran was weakened by sanctions, its regime remained stable and could continue funding Hezbollah, Hamas, and other proxy networks, weaving a web of threats around Israel. Israel had completely different expectations from Gulf states regarding America's security commitment in the Middle East. Gulf states wanted the U.S. to maintain the status quo. Israel wanted the U.S. to help change it. How the steady state was broken. The strike on the 28th of February 2026 destroyed every pillar of this equilibrium. The first pillar, Iran's passive cooperation. After Khamenei was killed, hardliners quickly seized power. Vahidi, an IRGC veteran internationally wanted for the Argentina bombing, was appointed as the new commander-in-chief. Larijani publicly announced refusal to negotiate with the United States. Two of the three members of the interim leadership committee were hardliners. Iranian regime scholars openly stated, Iran learned a bitter lesson from the June 2025 war. Restraint was interpreted as weakness. The era of strategic patience died with the supreme leader. Iran no longer had any willingness to maintain the strait's openness. More importantly, the incentive structure for closing the strait completely reversed. In the old equilibrium, an open strait benefited Iran. It could export oil. In the new reality, a closed strait benefits Iran. Soaring oil prices mean that even selling at a discount to China doubles revenue per barrel. The global energy crisis punishes the United States and Gulf states. China's selective passage deepens the China-Iran strategic bond. The second pillar, America's security guarantee. Trump announced government insurance and naval escorts, replicating the 1980s earnest will model. But the threat in 2026 is completely different from the 1980s. The 1980s threat was Iranian speedboats and anti-ship missiles, which U.S. warships could intercept. The 2026 threat is shore-based $20K Shahed drones, launched from any point along hundreds of kilometers of coastline. Aircraft carriers and escorts cannot stop them. As one analyst said, all Iran did was conduct a few drone strikes near the strait, and insurance companies and shipping firms deemed passage unsafe. Escorts solve visible blockades. They cannot solve the collapse of actuarial models. The third pillar, the institutional foundation of the insurance market. This is the most decisive rupture. More than half of the 12 members of the international group of P&I clubs issued 7 2-hour cancellation notices on March 1, with war risk insurance officially lapsing at 0000 GMT on March 5. Some have compared this event to the repo market freeze during the 2008 financial crisis. The difference: the 2008 repo market had TARP, Federal Reserve lending facilities, and FDIC deposit guarantees to repair it. The 2026 marine insurance market has no such intervention mechanisms in place, nor the institutional framework to create them at the required speed. One analyst estimates that even in the most favorable scenario, full recovery of the insurance market would take 6 to 18 months, the most unlikely alliance. The most ironic phenomenon in this war is that Israeli stock markets hit all-time highs after the war began. The TA-125 index surged nearly 6% in a single day on March 2 and continued rising afterward. Meanwhile, Dubai's stock market plunged 4.65%, and South Korea's Kospi collapsed 12.1% in a single day, triggering circuit breakers. This divergence reveals an interest structure almost no one publicly discusses. In destroying the Gulf energy order, Iran and Israel actually stand on the same side. Israel doesn't depend on Hormuz. Its energy comes from Mediterranean offshore gas fields, Leviathan and Tamar, exported via pipeline to Egypt, then liquefied at Egypt's LNG terminals for global export. This supply chain passes through no-conflict waters. In January 2026, Chevron just announced a $23.6 billion investment decision to nearly double Leviathan's capacity. Israel signed a $350 billion long-term gas export agreement with Egypt last year. When the Hormuz blockade causes Qatari LNG to disappear from global markets, Israel, as the marginal supplier of Mediterranean gas, sees the value of every cubic meter of its gas soaring. Goldman Sachs predicts Asian LNG spot prices could rise 130%. Israel's gas reserves aren't in the same league as Qatar's, about 1 trillion cubic meters versus 51 trillion, but in a severely short market. The marginal supplier gets the highest global price. The price of a bottle of water in the desert doesn't depend on how much water you have. It depends on how thirsty the people around you are. Israel benefits from this war's security dimension. Iran's military threat severely weakened, proxy networks dismantled. From the energy dimension, gas export prices doubled, geopolitical leverage enhanced, and from the geopolitical dimension, Qatari LNG paralysis makes Israel a regional alternative energy supplier. Therefore, Israel has no incentive to push for the war to end quickly or for energy stability to be restored. Israel is ensuring through concrete actions that the steady state cannot be restored. It bombed the Assembly of Experts meeting to elect a new supreme leader. It warned that any new supreme leader would be a clear target for elimination. It systematically eliminated Iranian officials the U.S. knew and might negotiate with. Trump himself lamented, "Most of the people we were considering are already dead. Soon we won't know any of them." Meanwhile, Iran, more precisely, IRGC hardliners, is tearing down the same order from another direction. IRGC advisors announced on television that the strait is closed and any passing vessel will be set ablaze. Each $20,000 Shahed drone launched raises the global oil price floor by $10, equivalent to adding $1 billion in daily costs to the global economy. The IRGC doesn't need sophisticated economic analysis to see. Sustained blockade of the strait means Iran's relative position is rising. Gulf monarchies' position is falling. Israeli gas is appreciating, and U.S. security credibility is damaged. Two mortal enemies, from two completely different directions, in completely different ways, are tearing down the same order that neither benefits from. This may not be coordinated action, but the effect is as if coordinated. Israel strikes from above, eliminating leaders, bombing command systems, blocking diplomatic channels. The IRGC sabotages from below, blocking the strait, attacking tankers, paralyzing insurance markets. Each side's actions reinforce the other's motivation to continue. The more Israel bombs, the more determined Iranian hardliners become. The longer the strait blockade, the more Israel profits from energy premiums. Who's paying the bill? In this redistribution of interests, the cost is mainly borne by four groups. Gulf monarchies bear the brunt. Their oil can't get out strait blockade, can't be stored, forced to shut in wells after storage saturation. Iraq's Rumaila field has begun shutdowns. Can't be sold, insurance collapse. Their entire wealth foundation is built on the premise that oil flows smoothly through Hormuz. When this premise is destroyed, Saudi Vision 2030, UAE economic diversification, and Qatar's LNG empire all face fundamental shocks. Japan and South Korea are two other disaster zones. Japan imports 95% of its oil from the Middle East, about 70% passing through Hormuz. South Korea gets about 70% of its oil from the Middle East. Over the past 40 years of steady state, these two countries built their entire economic structures around the assumption that Middle Eastern energy is cheap and reliably supplied. South Korea's Kospi plunged 12.1% on the war's second day, triggering circuit breakers. The yen, rather than appreciating like a traditional safe haven currency, is depreciating because soaring oil prices directly worsen Japan's trade balance. The Bank of Japan faces a dilemma. Not raising rates means continued yen depreciation and runaway inflation. Raising rates means pressure on the bond market and a 230% debt-to-GDP ratio becoming even more dangerous. The United States itself is also paying a price, though in more indirect ways. The U.S. doesn't directly depend on Hormuz oil, but a considerable part of U.S. global hegemony is built on the promise of guaranteeing global energy security. When this promise proves undeliverable, America's alliance system begins to loosen. The surge in short-term rates indicates markets are repricing the Fed's rate path. Oil price shocks mean rising inflation. Rising inflation means the path to rate cuts is blocked. Blocked cuts mean the entire AI supercycle narrative's assumption of loose financial conditions faces challenges. The premise of high valuations in financial markets that the U.S. economy depends on faces systemic collapse. From 1979 to 2026. The historical analogy most helpful for understanding the current situation is not the 1984 tanker war, but the 1979 Islamic Revolution itself. Before 1979, energy stability was jointly maintained by the United States, Iran, and Saudi Arabia. The revolution destroyed this steady state. Oil prices soared, and it took the world nearly a decade to construct a new equilibrium. The core concession of that new equilibrium was, accept Iran's existence as an enemy, but rely on Iran rationally choosing not to touch the straight red line. This new equilibrium lasted nearly 40 years. The 2026 war ended it. The act of assassinating Khamenei not only eliminated a person, but also eliminated the political foundation for maintaining equilibrium. You cannot kill a country's supreme leader and then expect that country to continue cooperating with you to maintain global public goods. After 1979, oil prices stayed high for 6 or 7 years before truly beginning to fall. The new equilibrium could be established because multiple forces worked simultaneously. Non-OPEC production areas, North Sea, Alaska, developed and increased output. The West dramatically improved energy efficiency. Saudi Arabia regulated the market as swing producer. U.S. Navy escorts effectively deterred Iran, and insurance markets continued operating. Most importantly, although hostile, Iran chose to cooperate. The 2026 situation is worse in almost all these dimensions. No equivalent new production areas are about to come online. What's blocked is not just one country's exports, Iran, but all exports passing through Hormuz, including Saudi Arabia, Iraq, UAE, Kuwait, and Qatar. The insurance market, already drained of capital buffers by the Red Sea crisis, collapsed with one blow. U.S. military escorts cannot counter the asymmetric threat of Shahed drones. And most critically, neither Iran nor Israel has any incentive to restore the system to the old equilibrium. A country excluded from the old order, Iran, and a country threatened by the old order, Israel, are each tearing down, from different directions, the same arrangement that neither benefits from. The cost of dismantling is borne by the old order's beneficiaries. Gulf monarchies lose export routes. Japan and South Korea lose energy security. The United States loses security credibility. And the global economy loses the implicit premise of low oil prices. Conclusion. Markets are still using a shock-then-recovery framework to understand this war, assuming everything will return to normal in a few weeks, but this is not a shock. The conditions that maintained the old equilibrium have been fundamentally destroyed. The last time an equilibrium rupture of this magnitude occurred was in 1979. After that, it took nearly a decade for a new equilibrium to form. This rupture may be even deeper. For all assets priced on the assumption that cheap energy is the default condition, this means their pricing premise has been irreversibly changed.